In May of 2021, Square changed their name to Block Inc. This once very high-flying, technologically oriented stock in data processing and outsourced services was flying really high and stayed there for years. But then notice how the bear market has brought a massive correction. Stay tuned to this video and we'll explain more about Block Inc. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. Once again, pleased to bring you a subscriber request Tuesday video. In videos like this, what I do is I look at requests that you, the subscribers to this channel, have asked to see. And I always find it very interesting what you're looking at and why you're looking at it, or trying to hypothesize perhaps why you're looking at these companies. And, this week is no different. Now, I'm also going to do something else here on this week's video that I think is very interesting. First of all, I'm going to use the new, soon-to-be-released version of Fast Graphs. We plan to launch this about August 1st. There are some exciting new features, and I'm going to try to showcase those. So for those of you who are subscribers, it's going to be kind of a preview introduction into what you have to look forward to in some of the features. This new version is more mobile friendly. It has less scrolling. The navigation has changed. We're trying to give you a better user experience, every day. And we think this new version fits that bill. We do have a few beta testers working with it, and we're getting some really nice comments. Now, the other thing I'm doing, though, when I do these videos, regardless of which, the newest version or even the current version of Fast Graphs that I'm using, I'm trying to give you methodologies and ways to think about stock prices. I want to remind everybody that Fast Graphs is an acronym for Fundamentals Analyzer Software Tool, and I call it a tool to think with. And so one of my secondary objectives here is to try to give you some insights into how you can think with this tool. It's a really valuation-oriented tool. I always say we don't try to dictate value to you, the subscriber. We try to reveal it. We try to give you information that can help you make rational, long-term investing decisions. And even frankly, for traders, it actually has some benefits in that regard too. So I'm going to cover 12 stocks today. I'm going to look at those stocks, and, I've got Davita, Enbridge, KKR, Kroger, LyondellBasell, Sherwin Williams, Block, which is Square, which I featured, Smith & Wesson, Turkcell, I'm not even going to try to pronounce that. That's a Turkish company, United Rentals, VICI Properties, which is a destinational REIT. Now, I'll talk about that, entertainment REIT, and then Williams Sonoma. So you've got a kind of diverse group of companies here. And we're going to start out by looking at Davita. Now, with this new version of Fast Graphs, I want you to note that we've moved the navigation to the left-hand side so you can see the whole chart in the graph without doing a lot of scrolling like you had to do in the past. Now, I can even increase the size of this a little bit. I'm going to move this up to 100, and still you have minimal scrolling. You can generally see the whole chart in the current view you're in, so that's one advantage. Now, Davita is an interesting company. The external links we've moved to right under the name of the company. I always suggest as subscribers you go to the company's website, and you can see that Davita is a kidney dialysis company. And, what they do is they do kidney dialysis. They also provide, all types of other support for kidney patients. So it's a very important company. You can go in here and look at about Davita, for example. They're on a quest to build the greatest healthcare community the world's ever seen. That's their goals. They have greater than 200,000 dialysis patients, blah, blah, blah. You can learn an awful lot about the company by visiting its websites here. But we're going to look at it today from a standpoint of what kind of investment this is. Well, number one, this is, as you can see, there's no dividend yield. Those of you familiar with the tool, what you've got here is a plotting of earnings per share. So I'll take weekly closing prices, and you can see that this company's had pretty consistent earnings growth, kind of went through a flat spell from 2013 up through 2018, and we'll see how price reacted. And then, pre-COVID, they really had some really strong increases. And then even post-COVID, they had some strong increase. You could see earnings started to grow dramatically, 51%, 34%, and 26%. their long-term growth rate has been almost 16% a year. And so we're using a P equals growth rate formula here. We're drawing the PE on this orange line at 15.95. And incidentally, the blue line, which is the normal market value that the market applies to it, has been about 17. So you can see there's kind of a tight valuation reference here. If I put price on the graph, you can see that price clearly tracks where the company went. Now, during the flat years, we had 3 or 4 years of underperformance, then followed by some really great performance. We're expecting a down year for this fiscal year, which ends in December. And notice there's been a very strong reaction to the price. Now, if I was looking forward, I've learned a lot about the company just by looking at the best. So I thought about what kind of company am I, endeavoring to invest in here. And I would call this a growth stock, obviously. Now, as far as what the future was going to look like, and that's where I'm going to be an investor, I would expect I'm probably going to have a relatively weak year this year. So there's a very possibility in the next 2 quarters, as they report them, I could see some bad news. Now, there's always a chance for surprises. I want you to notice that earnings numbers have been actually falling according to the analysts, and there's only 5 analysts following the company for 2022. We're expecting 780, which is a slight uptick to what the most recent estimate was. So perhaps things are starting to improve. These are things you want to look at. You can always check a company's analyst scorecard. This company has a very good scorecard, which means analysts have tended to get this right when they were, pre-forecasting 1 year in advance or precasting even 2 year in advance. So that's a plus, meaning that, when you're looking at forecasting, you might have some pretty reliable stuff to look at. So another thing I always like to do is I want to compare performance. Now, an interesting feature that we've added to this tool, and I'm comparing it here to Apple. So this is Davita versus Apple. All right. And this is dividends, growth, et cetera. And Apple's obviously been one of the best performers. But if you go to the settings version, this is something very exciting for you guys. And you go into comparisons and you go ahead and type in SPY, which is the Spider ETF, which is what we've, traditionally compared this to. And then go ahead and put the full symbol in for this, and then, save your changes. So you apply this new theory, you can save your changes, and you can see I've now compared it to the SPY. That's really what you want to do. You want to compare it to the market. But as I'll show in a future video, now we're giving you the ability here to do that. Now, I do want to make a point. This thing is still got some bugs in it. So that's why we're going to be waiting till August till we fully test it and work it. But this is one of the new exciting features that we're going to be giving you. Now, remember, at Fast Graphs, this is a growth stock. So primarily, I really like earnings here, but you can look at other metrics such as earnings before interest, taxes, and depreciation, EBITDA. You can also look at this company based on what its sales are and sales and revenues. And the bottom line is, no matter how I would look at Davita here, if I was a growth stock investor, and I'm currently not, okay, but as a growth stock investor, I would say this stock looks extremely attractive. The bear market has given us this opportunity. It's really a matter of earnings falling, but a lot of the other metrics are actually holding up, including things like cash flow, which are, showing a few signs of weakness compared to earnings. But the bottom line is I see this as a very inexpensive stock. And so if you're looking for growth, this is one that you might actually want to consider and take a look at. The next stock that I'm going to go ahead and look at is Enbridge. Now, Enbridge is a little different animal, and this is why I want to point out, to think about. This is an oil and gas storage and transportation pipeline company. Once again, you can quickly go into the company's website and you can learn an awful lot about what the company does. You can go into news, you can go into, investor services and look for presentations. The idea is we've created a research tool here that makes it easier for you to research stocks. But note that this company has a dividend yield of 6.39%, and it's actually paying out more in dividends than it's currently earning. The problem with this is, as I'll elaborate, as I've elaborated in previous videos, when you're dealing with these high yield stocks like this, these MLPs and REITs is another example of stocks, you'll see that they often issue a lot of shares. You can discover that by going into fund graphs, by going into the financials. Now, we're also going to be including the full financial statements in this new updated series, where you'll be able to look at the whole financial statement of the company. And, that would include, the balance sheet, the income statement, and so on. But you can also look at fund graphs where you can look at, some of the old, what you're currently used to for those of you who are premium subscribers, and look at things like ratios and so on. And, one of the things that I want to point out here when you're looking at a master limited partnership like that is they tend to be dilutive at times. And so you can see that for the last several years, the company's been issuing shares. That's one reason I don't like to look at it from the standpoint of, looking at it strictly from a standpoint of earnings, because you're looking at different share counts. So I like to look at it from a standpoint of cash flows. And what I'm seeing here, really, because of the high income, the company is covering their dividend by their cash flows and doing it by a very significant margin. The white line on the graph is the dividend. The orange and blue lines here are multiples of the cash flow. So this company is obviously generating cash flow. Now, free cash flow is a little different matter because of the CapEx requirements and so on. They don't really necessarily cover it with CapEx. So if you're looking at just, how safe is the income, it looks good. And you can also, obviously, of course, go into fund graphs and look at your health check, or into the financial section and look at your health check. But the bottom line is this is all about the income. Now, looking at it from a performance point of view, this company has a really good historical performance. Now, you wouldn't want to compare this to Apple, so I want to make it clear. Now, this is supposed to hold this, but it's not doing it yet. So as I point out, it's a little buggy. So I'm going to have to change it again for you. And bear with me. I'm going to go back in and put the SPY. And with this particular one, I got to put $US because this is an ETF, is what it is. And so I save the changes. And now I've got a comparison to the ETF, or the overall stock market, as measured by the S&P 500, if you will. And, you can compare the growth has been underperforming the market, but the total dividends have been outperforming the market by a rather large amount. So again, when you're looking at a stock like Enbridge, you can see that there's not a lot of growth here, less than 1% a year. And you can see relatively low multiples. The market therefore penalizes this company, if you will, with rather low multiples of operating cash flow. If I did look at operating earnings, it does give it a relatively high normal PE ratio of about 22, but that's really not the way to look at that. You want to look at this, as multiples of cash flow, because it is a dividend paying stock. So something around 10 times cash flow is a good value. The stock is currently, trading at just slightly under that 9.86, offers a 6.39%. If I'm looking at the future, we look for modest growth going forward, but, the operating cash flow growth with prices of oil and so on could be higher than normal. If I'm looking at the normal multiple, which is, again, below 10 times cash flow, we have really not a lot of growth here. We have a double-digit rate of return, but most of it coming from the income. So if you wanted to look at Enbridge, you would want to look at it from the standpoint of operating cash flow rather than earnings. And again, think of it as a dividend payer, not a growth stock. That's really the key here. The next one I want to look at is KKR. And I'm going to look at this from earnings. Now, this is an asset management and custody bank company. I've covered those recently in recent videos. There's some things to note here. Number one is the dividend has been rather spotty. So, even though it's offering a 1.31% dividend yield, which is slightly below the market, and even though it looks currently undervalued, I think you have to take into account the cyclical nature of this company and the very poor dividend record. They have cut their dividend several times in the past. So you're dealing with more of a speculation here. If I'm looking at performance of it is decent over time. And even with it being currently undervalued right now, it's been kind of decent, but it's very cyclical, but we have seen very strong, capital appreciation and growth, but now the market has brought it into a correction basis. So looking at forecasting, the company looks very nice, expected to grow at about 7%. The normal multiple gives you a great opportunity here. So I would call this a speculation. It is an A-rated company if you believe the growth, but then again, what you always want to do when you're looking at something like this is you want to go into the fast graph forecasting. You want to check the analyst scorecard, and they have a very poor analyst scorecard, which is a tribute to the cyclical nature of their earnings. So keep that in mind. Even though it looks real good, What I'm really suggesting to you guys is that you really need to do your homework with this company, and you need to be very careful. It's a quality company, doesn't offer much in dividend, has a very spotty dividend record. The stock does look inexpensive. That's one of the things that's got going for it. But, I'd be careful with that one. It's not my personal cup of tea. Now, the next one we're going to look at very quickly is Kroger. Kroger is, obviously your basic food company. It is reasonably priced. It was overvalued a few years ago. It's not a real fast grower, I want to point out. Since COVID, it did get a little spike, so we got a nice growth forecast. Looking at it forecasting-wise, it's only expected to grow about 3.5% to 4%. Long-term growth is expected to be a little better than that. But again, you want to be careful. You want to check the analyst scorecard. It has a good record. This one is a good quality basic food company. It's BBB rated, which is investment grade. You can see that your performance records in the past have been, a little spotty from time to time. You got to really buy this one right to make any money, even when it's undervalued here. Looking at it going forward in the future, it may or may not be a really strong investment. But if you look at buying it when it was cheap in the past, even though it's cheap now, it's been a very strong performer. So you want to be very careful with valuation here. Analyst scorecard has been excellent. These are very predictable companies. Kroger does offer an above-market dividend yield of 2.17%. It offers a healthy earnings yield. You can buy it at a good discount to value. It has a slight margin of safety. So you might want to take a look for Kroger if you're looking for something basic and solid. Kroger looks pretty good. I'm going to start going a little faster now. I've been trying to orient you to the tool. LyondellBasell, this is one you've got to get rid of some of this anomalous information here. It had a big spike in COVID. It's a BBB rated company, trading at a very low valuation. This isn't expected to have very much growth, but it is trading at a very low valuation. So that's something to be cautious about when you're looking at it. I'd be very careful here. This isn't the kind of company that you can really just count on year after year after year. I think that's critical. From an analyst scorecard, it does have a decent analyst scorecard. The analysts have been able to get the estimates pretty, good on this. But again, I'd be careful because we're not really expecting a whole lot out of the growth side on this one. Now, Sherwin Williams is an interesting one that I do want to feature and talk about here because Sherwin Williams is a very consistent stock. It's a BBB rated company. We all know it, for the specialty chemicals, but paint is what Sherwin Williams is primarily known for. We've had a very strong housing market. Earnings have been very, very good, even for the last decade or so. We looked at earnings growth over 15%. The market liked that and put a premium valuation of almost 27 times earnings. It has corrected back to that level. So if you want to be aggressive, you could argue this would be a good time to buy it. Dividend yield is under 1%, I might point out, but you're paying a very high premium. If you look at this from a long-term perspective, I see this company going back to a normal 15 times earnings company. If I look at adjusted operating earnings growth is still expected to remain strong at over 15% times earnings, but it does not look good from a standpoint of reverting to the mean. From a normal multiple, it looks fairly valued, but that to me is an aggressive forecast. That's expecting the market to continue to value this at a very high level. If the housing market changes dramatically, then that's really a problem. Square is the one that I covered, that I featured in the beginning here of this video. And again, this is a new company that creates, payments and so on, payment processing. You can go to their website. This used to be called Square. It's now called Block. They provide all these ways for you to, pay your bills. They have this new Square that allows you to use an iPad as a way to, to make payments and collect payments. So it's the Square stand coming up here. There's a lot of very interesting things about this company. But the one thing I want to point out, this was a very hot commodity for a couple of years, especially coming out of COVID. It's now, corrected dramatically. If you look at kind of a peak to trough correction here, it's fallen over 75%. For my personal money and my personal taste, I don't think it's gotten anywhere near cheap enough yet. Looking at it from a standpoint of analyst scorecard, it's been, pretty decent. It's such a new company. I'd be careful with Square. Smith & Wesson is another one that's, controversial for what they do and what they make. Obviously, they make guns. The stock has had a very cyclical historical record. Analyst scorecard is okay. It's not great. It's not bad. It does look inexpensive now from a standpoint of forecasting. There's a lot of talk about gun control and so on going on. So, I'd want to be careful. This stock is down for a reason. People ask me about that in the comment sections all the time. This stock has a reason to be down. We don't really know what the forecasts are going to be. We know that the forecasts have been lowered dramatically. They've gone from, the most recent forecast was 223. It's now down to 198. You can see that, it's not expected to perform very well going forward. So you might be looking at dead money here. I'd be very careful with Smith & Wesson if I was you. This is a Turkish-based company. It's an ADR. This is the one I refuse to try to pronounce. I always get flack from, subscribers because of the way I mispronounce the names of these companies. But you can see this is an ADR. It's 2.5 times. So you're not looking at the company here. You're looking at a unit, an American Depository Report. And what you've got here is dividends are very, very sketchy. All right, the analyst scorecard for this company is very, very sketchy, as you can see, so I'd be very, very careful. It's an ADR, there's not a lot, but from a standpoint of forecasting, I can see why subscribers are interested in looking at it. It does have strong potential growth going forward. It would be very, very cheap, but I would suggest you really got to do your homework here. That's a company that I don't think you can just look at a fast graph or anything like that and say, hey, this is really a good buy here. The next one I want to look at is United Rentals. This is a reasonably attractive growth stock. It's a good quality company. It's had very consistent growth going forward. United Rentals is forecast to grow at about 18% a year, so it's going to continue its strong growth. I like this company. I think it's a decent company. It's only BB+. It's not investment grade. For growth stocks, as growth stocks go, I think this company is pretty interesting. It's got a good analyst scorecard, meaning the analysts have been able to, forecast this one pretty well. It certainly has a good track record. You can see that the company, even though it's undervalued today, has generated very strong long-term rates of return. It does look very inexpensive. Earnings yield is almost 10%. No dividend, of course. This is really just a pure growth stock. If you were a growth stock investor, now would be the time to look at United Rentals. This is a destination REIT here, and this is a very interesting company. Now, I want to point out using fast graphs here, you want to take fast graphs and you want to get rid of anomalous information like this. So I'm going to shorten the time frame here. This is really about a 6 or 7% grower. It's forecast to grow at about 6 or 7%. I want you to notice that. It does offer a nice 6.5% yield. I consider it fully valued, not necessarily overvalued. I don't certainly consider it cheap, but if you're looking for current income and you're willing to, make a long-term commitment here, you could buy this one at these prices for the dividend, for the 6.5% yield. Think of it as a bond. And if it did get a correction here in this coming, market we're looking at, it would be the kind of company, if you're a long-term investor, that you might want to add more to. And then finally, Williams Sonoma, the last one on the list. You can see the price-earnings correlation. The company got a real nice pop out of COVID and had some really good, strong performance here. Yields about 2.5%. It's very, very inexpensive relative to earnings growth. However, earnings growth is only expected to be 4 or 5%. And even if you base this one on the normal multiple of around, let's say, under 15 times earnings, and of course it's well below that, it's only trading at 8 times earnings now, there would be very strong rates of return potential for this company going forward. The analyst scorecard here is excellent. They've either gotten the estimates right or the company's beaten analyst estimates most of the time. I like the company for its valuation. It doesn't have a credit rating. You all know Williams Sonoma, I think, by, as a retailer here about, of all the products they sell, all the different types of equipment. So this would be one that could be interesting. The bear market and the recent recession could have given us a good opportunity for an entry point if you're looking for this kind of company. So Williams Sonoma looks cheap to me. Anyway, this has been Chuck Carnevale taking you through another subscriber request Tuesday video. I want you to make special note of how different all these stocks were. I want you to take note of different ways that I've used the tool to try to evaluate things. I want you to use it to help conduct your further research. If you haven't subscribed to my channel, please do. If you like the video, give me a like, ring the bell, and take a look at Fast Graphs. What a wonderful tool. And we've got some really exciting new features coming up, including that comparison feature, which I'll feature more in forthcoming videos. Thanks for watching. Appreciate you guys.